Cary Stamp, and I want to tell you something today. We are on the doorstep of a very historic event in our country. Over the next 10 years, something is going to happen that is absolutely unprecedented. We're going to have 70 million baby boomers retire. That's more people that are going to be retiring in this 10-year period of time that have retired in the history of our country since its founding over 200 years ago. It's a dramatic impact that's going to have a major, major change on what's going on with the United States, what's going on with our economy, and how we're able to fund our liabilities and the promises that we've made to these folks that are retiring. We live in a volatile, uncertain, complex, and ambiguous world. We have a baby boomer explosion. 12,000 people are going to be retiring every single day for the next 20, 30, 40 years. 34% of all these people are going to expect Social Security payments to be their primary source of income when they retire. And of those folks that are retiring, on average, they only have $147,000 saved in their household accounts for retirement. This is a problem. The other problem is the fact that we've got a burgeoning federal debt and federal deficit every single year. If you look back to where our federal debt has been and where it's gone in the last 20 years, it's astounding. We now, at the beginning of this year, owed over $20 trillion in debt as a country. And in the last few months, we have made significant expenditures, especially to bail ourselves out of the pandemic that's going across our country right now. So this $20 trillion in debt is not even considering the additional $8 or $9 or $10 trillion that we're going to spend trying to save the country from the ravages of COVID-19. This begs the question, how are we going to pay for all of this? Where's the money going to come from? Well, right now, as a percentage of what our country spends, our percentage of our gross domestic product, every year, our federal debt is about the same as the total expenditures of the entire country. Every year, our total federal debt is about the same as the expenditures of our entire country. What's that mean? That means we're spending way, way more money than we can afford to spend long term. It means that you would be earning as much every single year as you have in debt on your balance sheet right now. If you look back at history in 2000, somewhere around 50% or 55% of our gross domestic product, that equated for the federal debt. But now as you follow this chart upwards and it continues to rise, in 2020, it's well over 100% of our gross domestic product is accounted for in federal debt. Another major challenge is that this debt is primarily paid for by individuals like you and I. It comes out of our paychecks and it comes out of our payroll taxes. Very little, if you can see the yellow part of my slide, very little of our income taxes come from corporate taxes. The corporate taxes actually have gone down, and as part of the Tax Cuts and Jobs Act that passed at the end of 2018, corporate tax rates went down to 21% from 35%. That's a major decrease. So even a smaller percentage is coming from corporate taxes, and we're looking at individuals to fund this massive growing federal debt. I'd like to take just a moment to pause and reflect on how one guy that I happen to know provided himself a extraordinarily successful retirement. And the gentleman was a man that I met when I was living in Chicago. I was a financial advisor at a firm in Chicago that was on Wacker Drive in downtown Chicago. It was a big office downtown, but the firm also had some smaller offices that were around the city. And in these smaller offices, there were individuals that just kind of were neighborhood stockbrokers or financial advisors. And one of these fellows left his office so that he could go to a different brokerage firm. And when he left the office, they sent me, because I was the assistant manager of the office downtown, up to the northwest side of Chicago to clean out his office. And I have to tell you, this wasn't the healthiest individual, because I got to the office, it was a mess. It was a wreck. It was like a storefront in a 3-flat building in the northwest side of Chicago. Very Polish and Irish neighborhood, Polish delis and bakeries and whatever, all over the neighborhood. And so I'm in there one day, actually cleaning out the office. And I'm pulling out like beer cans that are just thrown around the office, and ashtrays that he'd left that were full. He wasn't the healthiest guy. And I hear a knock on the door of the office, and I couldn't figure out who was trying to come in. So I went to the door, and I see this little guy, and he's kind of rattly dressed, and I figure he's there. He wants something. He wants some type of a handout. And I open the door, and he looks at me and he goes, "Ray!" And then he looks again. He says, "Oh, you're not Ray." I said, "No, I'm not Ray, but how can I help you?" He said, "Oh, I had talked to Ray, and he was going to help me with some things, because my wife had passed away, and we had her name on our stock certificates, and I wanted to be able to take her name off of the stock certificates." And I said, "Okay." And he proceeded to tell me that how he got these. The guy's name was Lenny, and we became great friends. And his daughter and her family are still clients of the firm today. This was probably over 20 years ago. And he started to tell me that he was a janitor in a high-rise building on Oak Street in Chicago. And Oak Street's a very fancy street. There's all of the fancy stores, the Prada and the Hermes and Louis Vuitton and everything else is right on Oak Street. It's Oak intersects with Michigan Avenue, if you can kind of picture this in Chicago. And he said, "Well, I was a janitor at this high-rise building, and I met this lady, and her name was Mrs. Rosen. And Mrs. Rosen had said to me that any time that I wanted, I could buy some stocks from her. And she even gave me a few shares of a few different companies. And one of those companies was AT&T. And if you remember, this was back before the time that AT&T had divested itself of a bunch of different entities like Verizon and Bell South and Bell Atlantic when the AT&T breakup happened. And so he came in and he had a stack of stock certificates like this that were all these different Bell companies, GTE, et cetera. And he had a few others. He had GE, he had General Motors, he had a little Walmart, he had a little Procter & Gamble. And I said, "Where did you get all these?" He said, "Well, every once in a while, I'd ask Mrs. Rosen, can I buy a few shares of this? And she'd have her broker transfer them to my name and send me out a certificate." And so every time I had a little bit of extra money, I did that. I said, "How long have you been doing this?" He kind of scratched his head and he said, "Well, probably about 35, 40 years. And I said, "Okay, and how much do you have?" He said, "I really don't know, but I suspect there's at least a couple $100,000 worth of certificates here." Now, you got to understand, Lenny was literally the janitor in this building. He was never paid more than $18,000 a year at any time in his entire life. He was living in the garden unit of a 3-flat apartment on the northwest side of Chicago. And if you can picture this, it's not really tiny, but it's probably not any more than 1,400 feet. And that's where he lived with his wife, and that's where he raised his daughter, and he rented this apartment for years and years and years. So I took the certificates, I deposited them in his account so that I could take the wife's name off of them. And I called him up a few days later. And I said, "Lenny, we got your certificates deposited. They're in the account. We're going to re-register them into your name." And I said, "Do you want to know how much they are?" He said, "Yeah, sure. It doesn't really matter because I'm not going to sell anything. It's not going to change my life at all in any way." I said, "That's great, because you have $1.4 million in these securities and all of these companies." And he said, "What?" I said, "Yeah, $1.4 million. Why? Because he had bought good quality securities. He'd held on to them for a very long time. And he'd never let his emotion or what was going on with the market get in the way of what he was doing. It's an amazing story, and it's one that I tell all of our young people that come to work with us and all of our new clients, because I think it really emphasizes the perspective of having a long-term view and not trying to figure out what's happening day to day in the markets. There are some really evil forces at work in the equity markets. There are evil forces at work in the economy, I should say. And those two twin evils are the idea of taxes and inflation. I'm going to talk about taxes first and how this is incredibly important to your long-term retirement success, and then we'll move on to inflation. When we put this together today, I promised my team that there would be no pie charts. We weren't going to do any pie charts and tell people put a little bit of your money here and a little bit of your money here, here's how you do it. That's a conversation you need to have with your advisor, but that's about asset allocation. What I would like to address and tell you it's just as important is asset location, because asset location determines how much taxes you're going to pay in retirement. So we practice a process called tax diversification as part of our asset location process here. And what this is we try to figure out, where is your money? Is it in taxable accounts? These would be your brokerage accounts, your CDs, your stocks that you own in your own individual names, etc. Your tax deferred accounts are things like your IRAs, your annuities. You put the money in now, you don't have to pay any tax on it until you draw the money out, but you're building up inside of that account a tax liability that has to be paid at some point in the future. And then the third type of account, or the third type of asset location, is called the tax exempt bucket. And in this, we would have things like municipal bonds, which pay interest that's not federally taxable. You would also have Roth IRAs, because if you have a Roth IRA and you take money out of the Roth IRA, you don't pay any income tax on the distributions that you make from the Roth IRA. And the last category is cash value life insurance. If you have a life insurance policy, you can actually use it as a retirement vehicle by putting a significant amount of cash into that policy, paying very little for the cost of the insurance if you like, and be able to take money out in retirement, income tax free for the entirety of your life. And when you pass away, whatever's left continues to go to your heirs and your beneficiaries without any estate taxes or income taxes if you've structured it properly. There are a few things, however, that you need to think about when we are managing taxable income. So if you have substantial income, you're going to lose out on some tax deductions and tax credits. And I think most of us were aware that part of the Tax Cuts and Jobs Act in 2018 did away with a lot of the things that we were previously able to itemize on our income tax returns. So we have what's called the SALT limitation, which stands for state and local taxes. And what this says is that your state taxes, what you pay for your house, your property taxes, and what you would pay for your income taxes if you happen to live in a state that charges income taxes are capped at a $10,000 deduction. So as a result, many people are no longer able to itemize on their income tax return, and they file with what is called the standard deduction. Well, we've lost a lot of itemized deductions as a result of that. So some folks in retirement are actually paying more taxes than they realize. The rates have gone down, but very few people actually got a tax cut as a result of that legislation. The other thing that happens is that if you earn substantial income in retirement, that it can cause your Social Security income to become taxable. And if you make, as a couple, more than $44,000 in 2020, then 85% of your Social Security income is going to be taxed. 85% of your Social Security income is going to be taxed. And all you have to make is $44,000. So we need to talk about what some of these strategies are, and I'll get to that in just a moment. The other thing that happens is that if you pay Medicare Part B, and almost everybody that is over age 65 does, and you make a high income, it can raise your Medicare Part B premiums from somewhere around $100 a month to over $400 a month based on what your income is. This is a hidden tax that most people don't even know about. So's the next one, which is what's called the net investment income tax. If you have investment income, capital gains, dividends, these things all pay a 3.8% surtax on top of your capital gains rate. So most folks pay a 15% capital gains rate, but on top of that, you're going to pay this 3.8%. It sounds really good, 15%, but it's actually a little bit more. Now, when folks get to 72, used to be 70 and a half, and this just changed at the beginning of this year. When you get to 72, you have to start taking money out of your IRA, your traditional IRA account. This is going to create a substantial amount of income for a lot of people. So if you have $1 million IRA account and you retire and you're 72 years old, the IRS gives you a calculation and they say you have to take out this amount from your IRA every single year for the rest of your life. And the amount that you take out is 100% completely taxable. At age 72 on $1 million IRA, it's probably going to be somewhere between $40,000 and $45,000. But once you get to 80 or 85, it's going to be a substantially higher number because your life expectancy has been shortened and the amount that you have to withdraw is going to increase substantially. That means a lot more taxes are going to have to come out of your distribution, and your income's going to go up and your tax bracket is more than likely to go up. One other thing is that a lot of people don't realize that if they have municipal bonds, they're great, but municipal bond tax exempt interest is included in the Medicare and Social Security calculations. So when there are surtaxes on Social Security and Medicare, they include what you are taking out of your municipal bond interest or what you're earning on your municipal bond interest. Roth IRA distributions, not included in that calculation. Life insurance income distributions, not included in that calculations. So, do we pay taxes now? Do we pay a lot? Are they high? I think the answer is no. Right now, we have a pretty low tax rate. This chart shows the history of federal tax rates since they were instituted in 1913. Throughout most of history, tax rates have been above 50% of the top earners, or the 50% of the income of the top earners was taxed at the highest possible rate. This is the highest tax rate that we can pay. Right now, it stands at 37%. So if you live in the state of Florida or the state of Texas or the state of Nevada, and you're in the top tax rate, you pay 37% federal tax and no state income tax. However, if you live in Illinois, you live in Connecticut, you live in a state that does have a state income tax, you might even be paying 40, 45, or New York City, as much as 50% of your income to state and federal taxes. So it might seem like that's a lot, but on a historic basis, it's not. And I will suggest to you that there's probably a good argument that income tax rates are going to have to go up based on the information that we previously covered of how much our national debt has increased and what expenditures are on the horizon. Besides, there's those 70 million baby boomers that soon we're going to have to start paying Social Security to, or increasing their Social Security payments every single year. That's going to be a problem. Think back to when you first bought your first home or your first car, and what year it was approximately, and what it cost you. And this will talk a little bit to the idea that the money that we have today is going to erode over time, and that the only way that we can outpace inflation is by having our investments rise at a return that is substantially greater than the rate of inflation. So this is a purchasing power of a US dollar going back to the same period of time. And a dollar from about 100 years ago is only worth 1/20th of today what it was worth then, or 5 cents on the dollar. According to CNBC, the average price of a house in 1940, the average price of a house in 1940 was $2,400. In 1980, it was $47,000. And by 2000, that average house price was $120,000. So it went from 1940 at $2,400 to 2000 at $120,000. Think of what you paid for your first car, automobile expenses, everything else that we consume and that we enjoy will go up in cost. In order to prevent our portfolio from losing ground against the rising rates of inflation, you need to have a strategy. And that primary strategy that we talk to all of our clients about, and the one asset class that generally is going to outperform every other asset class, is equities. So one of the things, in addition to equities, that most people are going to rely on for retirement is Social Security. And Social Security does provide a fairly significant amount of income in retirement for most Americans. But how you claim Social Security is incredibly important. I'm going to share this video that I've created that talks about how to claim Social Security and when to start taking it.
This is a principled wealth moment. Today I'm going to talk about one of the most common questions that we get as financial advisors. And that question is very simple. When should you take your Social Security? So everybody has the option, if you have 40 quarters paid into the Social Security system, which essentially amounts to 10 years of work.
Okay. I'm going to get right back to that point.
Hi, I'm Cary. So everybody has the option, if you have 40 quarters paid into the Social Security system, which essentially amounts to 10 years of work, to take Social Security as a reduced benefit at age 62. Most people shouldn't do that, and I'll tell you why in just a moment. The rest of us, depending on when we were born, can generally take Social Security some point between 66, 66 and a half, or if you're a whippersnapper like me, at age 67. So that's what we call full retirement age in the Social Security system. So when you look at a benefits calculation, it generally gives you the benefit at your full retirement age. It'll probably give you the reduced benefit at age 62, but everyone also has another option. And the other option is to delay your Social Security. You can delay your Social Security for several years until you are age 70. If you choose to delay Social Security, you get an added bonus from the government. Every year that you delay between age 66, 66 and a half, or 67, you will get an 8% annual increase in your Social Security benefit. So if you think you're going to live a long time, if there's longevity in your family, or if you're making money between this age and this age, you may not want to have this income from Social Security so that you don't have to pay tax on it. This is a very complicated subject, and the answer is not the same for every single person. We have a calculator that we use. It's financial planning software that puts into that calculation what you earn, if you have a spouse, what they earn, how long you plan to work, and how long you plan to live. So if you want to know more information, you're welcome to call our office, 561-471-7700, or email me personally at Cary@carystamp.com. This is Social Security, the most common question that we get in the financial planning world. I'm Cary Stamp, and this has been a Principled Wealth Moment.
So, one of the most important decisions you're going to make is when to claim your Social Security. Every single client wants to claim it earlier than they should. They want to turn that check on. But if you have a normal life expectancy, the longer you can delay that Social Security payment, the numbers show the greater amount you will get throughout your lifetime. Kind of the cutoff age is if you expect you're going to live past age 85, then you should probably wait as long as possible to claim your Social Security. Again, we have a calculator that we can use, and we do for all of our clients. Andrew, who introduced me, has a master's of financial planning, and he does most of the financial analysis work and kind of the number crunching here at the firm. So he plugs in all of our clients' Social Security information based on the statement that they get at this website. If you haven't gotten one of those paper Social Security statements in a while, the reason is because they don't send them anymore. But you can go to this website and get your Social Security statement anytime you want. You can download it, you can print it, and you can make sure that your earnings history is accurate so that you're going to get the right amount of Social Security. We're going to shift now to another type of Social Security type benefit. And the other Social Security type benefit is what's called an annuity. And this is a common retirement strategy. The definition of annuity is simply a fixed sum of money that's paid to somebody each year or month, and it's typically paid for the rest of their life. And then when they pass away, those payments cease. Social Security is by definition an annuity. It's money that you get every month, and when you die, you get no more payments. A pension, if you worked for the school district, if you worked for the government, if you worked for the sheriff's department, if you worked for a very large corporation until the last 20 years, you probably got a pension, which is a guaranteed stream of retirement income. A pension is simply an annuity. It's a stream of payments. You can create your own pension by using an immediate annuity that you give some money to an insurance company and they pay you a stream of income for the rest of your life. Most people don't want to do this, but some folks do. If you are a nervous investor, if you know yourself and you say, I would panic if the stock market went down 20, 30, or 40%, and I would not wait. I would not wait for things to come back. I would get scared. Then you might want to consider it as a strategy, because the annuity payment is fixed. It's a set amount that gets into your mailbox every month. A lot of people call it mailbox money. It gets put into your bank account or your mailbox every single month. It's the same amount. You don't have to worry about it. You don't have to worry about the stock market. Well, we don't work a lot with annuities in our practice. I don't think that they're the worst investments in the world, as some people will say. I do think that there are quite a few that have extraordinarily high fees, and you need to understand what you're getting into and what you're buying before you consider making an annuity investment. The type of product that you use will have a major impact on what your long-term performance is. So we talked about taxes and we've talked about income. Now I want to talk about how you can get tax-free income, because this is really cool, and this is something that we do as part of our asset location strategy with our clients. There's two vehicles that you can use. Number one is life insurance, and number two is a Roth IRA. So people think of life insurance and they say, well, do you mean term life or do you mean whole life? Well, a lot of people think there's only really two types of life insurance, but there's not. There's a multitude of different variations of life insurance. You can invest in what look like mutual funds inside of life insurance accounts. You can invest in index-oriented investments inside of life insurance accounts, or you can just have a fixed rate of return where the insurance company pays you 3, 4, 5%, whatever their annual crediting rate is inside of their insurance policy. And you can accumulate funds inside of the insurance policy, buy very little death benefits so that the cost of the insurance is not particularly high, and save that money with the intention that you're going to take it out in retirement. And for folks that make substantial incomes and you've already maxed out your 401k plan, this can make a lot of sense, because you are putting money into a vehicle that is not only tax deferred, but when you take the assets out of that vehicle, it's going to come out tax free. And if you never take them out and you were to pass away and you have the life insurance policy, it goes to your beneficiaries without any inheritance tax or any income tax. The other thing is that if you're in Florida, let's say you're a professional, you're a doctor, you're a dentist, you're a lawyer, and you're worried about liability issues. And I work with a lot of real estate developers, and oftentimes they're worried about creditor issues because they've signed personal guarantees on loans. Any money that you have inside of a life insurance contract is exempt and protected from creditors in the state of Florida. Many other laws have similar states, but Florida in particular is especially good when it comes to life insurance as a creditor protected asset. Roth IRAs. A Roth IRA is a retirement account where the taxes on the investments or the corpus of that account have already been paid. So most of us are familiar with a traditional IRA. That's an account that we've put in an annual payment of $6,000 or $7,000. We've made that contribution and we've taken a deduction on our income tax returns in many cases. Or it's money that we put into our 401k and it was deducted from our taxable income from our employer. We never paid any tax on it. That's a traditional IRA. A Roth IRA is an account where the taxes have already been paid. You've taken $6,000 or $7,000, you've put that money into the account after tax, or you've taken it from the traditional IRA and moved it to the Roth IRA, and along the way you paid the income taxes to get it into the Roth IRA. If you have substantial assets, if you have assets that you expect that you're not going to use during your lifetime, and you have a traditional IRA, you are probably doing your heirs a major disservice by keeping the traditional IRA and not figuring out a way to convert it to a Roth IRA in the next few years. Why? The tax rules just changed. At the end of 2018, what was called the stretch IRA was eliminated. The stretch IRA said, if you inherit someone else's IRA and they're not your spouse, that you can take distributions from that IRA over your lifetime and spread it out over 20, 30, 40, 50 years, however long you live, and you only have to take out a little bit each year. That's no longer the case. Now on your IRA, your beneficiaries have to take out all of the money. If they're not your spouse can keep it for their lifetime. But if they're not your spouse, they have to take all of the money out within 10 years. They can take it out a little at each time, or they can take it out all in year 10. But at the end of 10 years, it all has to be taken out. And what happens to this money when you take it out? You pay tax on it. So all of those distributions for your beneficiaries are going to be taxable. Well, what if you live in Texas and you've got a substantial IRA and your kids live in Illinois, or they live in Connecticut, or they live in California? When they take the money out, they're going to pay the federal income tax, and they're going to get a blessing from their state, and they're going to pay the state income tax in the state where they live. So if you live in a state like Florida, where there's no state income tax, it might make a lot of sense to take money out of your traditional IRA right now, pay the tax on it so that it will go to your children in a Roth IRA, tax-free, and they won't have to pay taxes in other states on the money that you're taking out of the IRA. You also do not have what's called a required minimum distribution with a Roth IRA. The Roth IRA doesn't say at age 72 you have to start taking money out. You can leave the funds in for the balance of your life. When you pass away, your children do have the ability to take a small amount each year. They did not eliminate the stretch rules for Roth IRAs, so Roth IRAs can continue to be stretched out over the lifetime of the beneficiary. It's a great way to figure out how to leave money to your heirs on a tax-free basis. So these are two of the major strategies that we use to try to generate tax-free income in retirement. And if I pull this all together, often what we will do is we will set up a plan for a client that tries to determine how much income we want them to have each year, how much tax we want them to pay, and then we'll determine where we want to take their money from. Do you want to take it from traditional IRAs, Roth IRAs, life insurance, annuities, or just out of their investment and brokerage accounts? That's all part of the process. Now, I want to shift gears for just a moment. I want to talk about investor returns, because investor returns are driven by what's in this 4 inches between your two ears. Fidelity did a study, and this is a very famous study that they did about 20 years ago. And they looked at the investors in their equity funds or their stock funds. And they said, how have these folks performed over the last 30 years? And the answer was astounding. The average investor in one of their equity funds had only earned a return of about 4% per year over the 30-year period of time that they studied. But the market over that same period of time, represented by the S&P 500, had averaged a return of 9.5%. So why? What was the difference? What was going on? Most investors are like this guy on the ledge. They think that, oh my God, the market's gone down. I need to jump out, and then I will find a time to jump back in. It doesn't work that way, because you never are able to predict the time that you're going to need to get out and the time that you want to get back in. When things look the worst is when you should invest the most. And when things look the best is when you should invest the least and be the most cautious. This is the typical cycle. We start to get a period of optimism, and we start to see the idea that the market's going to continue to rise. And then we start to see equities enter what we call the euphoria stage. Everything goes up. You're at cocktail parties talking about how smart you are and what a great day trader you are. That, my friends, is the point of maximum financial risk. That is not the time when you should be thinking about adding a ton of more money to the market. That's when your head should be ringing the bell and saying, geez, maybe there's something going on here, and I need to look at what's going on and perhaps be a little bit cautious. So the markets start to go down. And what do people start to do? They start to feel anxious. They start to wonder, is it ever going to get better again? They get afraid. Fear drives investments and emotion. Richard Thaler, who's a behavioral economist, did a study on emotional intelligence in investors. He's a very famous economist, won the Nobel Prize at the University of Chicago. And they came up with the conclusion that investors fear the loss of a dollar twice as much as they feel the euphoria of gaining a dollar. We are programmed to want to avert losses far more than we are programmed to enjoy our gains. So people get scared when the markets start to go down. And then eventually desperation and panic set in, which leads to, oh my God, it's never going to get better again. I have to sell now. At exactly the wrong moment. That is the moment that JP Morgan, the famous banker, said, there is blood on the streets. And that is the moment when he said he likes to buy. Warren Buffett, the Oracle of Omaha, and one of the greatest investors of all time, says for most good quality equities, the best possible holding period is forever. So you want to have time in the market, not try timing the market. This is a recipe for disaster, and it's a recipe for why investors in Fidelity over that period of time only generated returns of 4% when the market was up 9%. So we're in a unique time. I haven't spent a lot of time talking about COVID-19, but the market went down. On March 23rd, it hit a low that was about 30% below where it had been just prior to that within a couple of weeks. And we've come back up a long ways since that time. The S&P is down for the year about 8 or 9%. The Dow's down about 13%. But the NASDAQ, which represents things like Apple and Microsoft and Amazon and Google, is actually up for the year. There's a major disconnect here. This situation that's going on in our country is very dire, is in terms of job losses and what's happening to the economy. The government and the Federal Reserve are pumping tons of money into the system to prop up the economy and prop up the stock market. It's going to work for a little while, but there will probably come a time when we start reporting corporate earnings that don't look so well. And corporate earnings are what drive equity prices and stock prices. So we need to be thinking about how we can protect ourselves, especially if you are close to retirement right now. And here are the things that we're telling our clients. Prepare in advance for a time when the market is going to go down. That doesn't mean that you panic when it does go down. You just sit tight and enjoy the ride, but you maintain a reserve in your investment accounts of short-term safe money in bonds, treasuries, CDs, fixed income, municipal bonds that can cover 3 to 5 years worth of living expenses. Why 3 to 5 years? The average market downturn is only 18 months. From the top to the bottom, back to where it was. It's only 18 months. Long downturns go 3 years. In 2007, in the financial crisis, it took 4 years for us to go top, bottom, back to where we were. If you have the money in short-term investments and you can spend that money while the market is down, you never have to sell a single high-quality stock while the market is declined. You're just going to sit there and wait for it to come back up. And this is what we use for your income during those periods of time. If you're truly nervous, just consider guaranteed income streams. There's nothing wrong with it. If it provides the income that you need for the rest of your life, and you say, I don't want to have to worry about all this stuff, put my money in an annuity and send me a check every single month. There's nothing wrong with that. Teachers, when they get their check every month from the retirement plan, are very happy people. You could be happy too, just getting a check every month from an annuity and not have to worry about the equity markets. So we always tell people own good quality equities, a well-diversified portfolio, hold them through the downturn and don't try to time the market. At times like we just had in March, We also use tax loss harvesting strategies. So if you bought that investment company of America and you put $100,000 into it and it went down because the market went down and it was $80,000, you can sell it. It owns large company US stocks. You can buy the Fidelity large company US stock fund. And when the market goes back up, both of those funds are going to go back up, but you've realized a $20,000 loss that you can use to offset your other income taxes up to $3,000 a year and your other capital gains taxes for the entirety of that loss. The other thing is that when you have the opportunity is to rebalance and take a look at what needs to happen in your portfolio. So every year we rebalance our portfolios and adjust risk tolerance. This is something you should also be thinking about doing. If you have a stock that's gone up in value, if you have Amazon, you have Facebook, you have Apple, whatever, trim it back periodically. Yeah, they've all been great stocks, but it's okay to take a little bit of money off the table if that means that your equity portion of your portfolio has gone up above where you would like it to be. Take some profits, move it into something that's a little bit more conservative and reduce the risk that you've got in the portfolio. So these are the immediate things that you should be thinking about doing right now. I do have an offer, of course, and a gift for those of you that are joining us today. Some of you are our clients, and we should be doing all of the things that I'm about to describe for you right now. And if we're not, please tell us immediately. We love feedback. We love constructive feedback in any form. Many of our families that we've worked with for 15 or 20 plus years. I've been a financial advisor for 30 years now. I think Andrew mentioned that. So our gift for you today for coming is that we know that you all have unique circumstances. I cannot possibly cover everything in a 1-hour webinar. I didn't talk about distribution rates. There's all kinds of different things that I did not talk about today. So as a thank you, any one of you is welcome to visit with one of our financial advisors. Many of them are CFPs, and they're all well-trained. We all use the same process to talk about your personal financial situation. We will not try to sell you anything. It's simply a conversation. We will determine if you're a good fit for us and we're a good fit for you. We'll give you impartial advice. We are advisors that look at always at the best interests of our clients. We don't sell products where we earn high commissions. That's part of our pledge or part of our commitment is our role as fiduciaries. We can meet you in your home, your office, or on Zoom. We're fine with any of those solutions. You don't have to bring us anything. You don't have to show us any of your information. It's just an introduction. And the meeting would take an hour or less. If you would like to talk to us, you're welcome to do that. If you're currently our clients and you have folks that you think we should talk to, please feel free to share this information with them. The webinar will also be available for replay. This is the other thing that we do for all of our clients or all of the folks that come in and work with us, is a retirement optimization plan. We do this for everybody internally. Some of our clients don't even realize that we've done this. We look at what the risks are in their portfolio, what their longevity needs are, what their lifestyle needs are, and their liquidity needs. And then we determine where are we going to have funds available to be able to take care of these folks in for those expenses. How do we allocate it? Stable income, their equity and diversified portfolio, and how much do we need to have available in cash? I have a great team. We have offices in Chicago, Connecticut, and I'm here in Tequesta, the Jupiter, Florida area. All of these folks have years of experience, and we all use the same principled wealth process. I will now open it up to questions. I'm happy to answer any questions that folks might have. And thank you all for joining us during this discussion of what to do right now in a retirement scenario where we're dealing with far more volatility than we've seen in a long time. So Andrew, if we have any questions that have come in, that would be great.
Yeah, Cary, I guess just one question to start, and it's kind of a pretty lighthearted question. They want to know where you got those nifty blue glasses.
So the blue glasses that are the same as the brown glasses that I have on, and they're called Easy Peasy, I-Z-I-P-I-Z-I, and you could buy them probably I don't think they sell them on Amazon, but if you Google it, there's a couple of places that also will sell the glasses.
So Cary, the next one is more of a statement on future retirees. So the question is everyone aware that there will soon be people retiring who will spend more years in retirement than they spend working? Specialist doctors, for example, don't start earning till around their early 30s and retire at around 65. If they live in their 90s, they will have a longer retirement than their working career. Now, if you want to touch on that, Cary, that kind of seems like the next phase after the boomers.
Yeah, that's a great question. And it's very true. And you need to make sure that for those folks that they've got longevity in their income. With the fact that people are living substantially longer than they used to, we're seeing retirement being extended. You used to retire at age 65. And if you lived 10 years, you usually had plenty of money. Now we're having people retire at age 65 and they're living 30 or 40 years. So they need to make some very serious calculations. Number one, what kind of a withdrawal rate can I take on my portfolio so that I don't run out of money, especially during a time when there might be a market downturn? How am I going to segregate some of my assets so during that downturn, I don't have to take money out of my equity portion? And then those folks should also probably look at strategies that just guarantees longevity or provide some type of insurance in their old age. We're all going to, in some fashion or another, need some type of health care or long-term care. And about half the people that pass away in this country have some type of long-term care, whether it's in their house or it's in an assisted living facility or a nursing home. About half the people in the country go through that process, and it's incredibly expensive. And it's something that you need to address to make sure you protect yourself in your retirement. So
Okay,
I see
that was the last question.
Okay. So I appreciate everyone joining us today. If you have specific questions, you're welcome to email me directly, Cary, C-A-R-Y, @carystamp.com. You can call the office, 561-471-7700. It's been a pleasure visiting with all of you today. And thank you so much for joining our webinar.